Hi everyone, so today I'm going to be covering Jazz Pharmaceuticals. I covered this company about a year ago, and at the time it was actually pretty good. It had great upside on Tipranks, but let's check Q2 2025 earnings to see what's going on now, because the stock really hasn't budged at all. So I'm going to share my screen again, and we're going to check what Google Gemini has summarized for us. So it came out August 5th, 2025, of course, and not great, I would say, earnings altogether. So we have a few things here. Total revenue increased only 2% year over year to 1.05 billion. The reported adjusted loss of $8.25 per share was wider than the average analyst estimate of a loss of $6.12 per share. This represents an earnings surprise of negative 34.8%, which is crazy. Again, revenue of $1 billion or 1.05 billion was slightly below the estimate of 1.05 billion, although it was slightly in line with the analyst expectation. I think the wording is a little bit weird here, but that was in line, but the EPS was not, or the adjusted loss was not, it seems like, which is a little bit problematic. Factors affecting the results: a significant factor impacting the net loss was a non-cash acquired in-process research and development IP R&D expense of $905 million related to the acquisition of Chimerix in drug dordaviprone. So growth in the neuroscience segment, particularly driven by the strong Xywav and Epidiolex sales, was positive. The problem is, just to keep in mind, is with pharma companies is they always have a lot of research and development costs or expense. That's why it's very hard for them to stay profitable and be profitable, and they always have to do constant acquisitions to improve their drug portfolio, to always innovate. This is one of the fundamental problems of a lot of the drug companies. If we check the financial guidance, they updated its full year 2025 guidance to a range of 4.15 billion to 4.3 billion, and the company also lowered its lower end of its full year non-GAAP adjusted EPS to $4.80 to $5.60. So again, not too great overall, I would say. But if we check simply Wall Street, the free cash flow is okay. You have 1.268 billion in 3 years, 1.7 billion. Problem is super slow, not great. The financial health of the company, this one's rough too. It's pretty rough. Cash is down, equity is down, and debt has stayed the same. Pretty much what you don't want to see happening is kind of happening here. They do have a lot of debt, and that's one of the problems that I have with the company as well. If we check my DCF is going to say it's undervalued by 80%, but I think this is quite unrealistic. If we check Wall Street forecast, which is 5% revenue growth, it's 69% undervalued, so maybe. And then if we check Tipranks, which, let me close that and reload it quickly, we're going to have 14 buys, 1 hold, an average of, because it's trading at 111, of 175. So yeah, I mean, it's definitely possible, but honestly, this is one of those stocks that could be more of a value play or value trap than it is a growth stock, from what I could tell by the debt levels and everything else. So thank you, everyone.